Hello, everyone. This is Greg Giardino of the Atlas team here at Wealth Enhancement, and I'm joined with my fellow team member, Steve Craffen. Steve and I, we are both fee-only financial planners here at Wealth Enhancement, which essentially means we only get compensated by our clients, not any third parties. And today's webinar is really a follow-up or follow-on from our articles that we write in MD Life. So Steve and I, we regularly publish an article focused around medical doctors and how they could better harness and protect their wealth. And our last publication that we released was around advanced life insurance and disability insurance planning. So today we have a really special presentation. Later, after our recording is done, it will be uploaded to our It's Your Smarter Money YouTube channel, which is our Atlas team. And it will also be uploaded to our Wealth Enhancement YouTube channel as well. So you can catch that if you need a replay. And of course, at the end of our presentation today, if you want to have a schedule, a initial consultation, you're happy to reach out to Howard, Steve, or myself and to maybe assess where you're at and where you're going. So with that being said, I'm going to swing things over to Steve. We have a special guest, Howard Udoff, today of Disability Insurance Services. And Steve, maybe you could tell our viewers a little bit more about Howard and his background.
Yeah, so I've known Howard for about 20 years. Howard just reminded me of that. And I guess that makes us only, 49, Howard, rather than 29? But I trust Howard. I know he's very knowledgeable, and I've worked together with him for several years. And Howard has been involved in disability insurance and long-term care and also life insurance sales for about 40 years plus. And was managed the Paul Revere Insurance Group brokerage office for many years. He actually raised their sales substantially in disability income. He won the President's Trophy and the Aubrey R.K. Reed Award for brokerage excellence. He oversaw all disability and long-term care insurance business for International Planning Alliance, a Guardian general agency. Howard, you with Guardian for how long? 23 years or?
28, yeah.
28 years, okay. And he's a founding member of the International Disability Insurance Society, and he's an active member and past president of the Newark Association of Life Underwriters. So we're really lucky and pleased to have Howard here, and he's going to get into some of the intricacies with respect to life insurance and disability and things to consider. Now, I just want to kick this off by saying that especially if you're a young medical professional and you haven't built up a lot in assets yet, but you have a young family, you want to make sure you protect that family by having enough life insurance. And so that's a key component of your financial planning. But you also want to protect your income against disability. In fact, I actually heard of a case recently by somebody in their early 40s, I think, and it was a surgeon. And that particular person lost some dexterity in their hands and obviously couldn't be a surgeon any longer. But because that person was well protected with disability insurance, probably about 300,000 years, the number I heard, they're pretty much going to be fine for the rest of their life, even though that person could never work as a surgeon again. So we're going to talk about that a little further. So the key with life insurance is, first of all, to determine how much you need, because you don't want to overspend the life insurance, but you don't want to make sure you're underinsured as well. And so Greg and I do pretty detailed financial planning to help determine needs in this area. Disability insurance, life insurance, also help you plan your investment portfolio, also help you plan on retirement. And we also do detailed tax planning as well. So Howard, we're going to talk about life insurance first. And, perhaps you can tell us what your philosophy is regarding life insurance, especially for a young professional. And we'll get into possibly older people.
Well, thank you, Steve and Greg, for the introduction. Appreciate that. And my experience has been that when you're young and your family is just starting out, you need to have a significant amount of life insurance because you haven't had enough years of earning to grow your assets and become, self-insured as some people do later in life. In fact, Steve and I were talking about that earlier today. So the need for life insurance is greater when you're younger and your family is young and your kids are dependent on you, right? So what is the number? It's not like a magic number, and there's always different formulas that people use for human life value. which is, what you're worth to your family if you're no longer here. But I think you have to look at what your expenses are, what it would cost to raise your kids and put them through college, whether your wife is working, contributing to the financial picture there. So there's no hard number, but my advice is always to get as much face amount life insurance while you're young, and have the ability, if it's term insurance, to convert that life insurance policy later on if needed. So the cheapest life insurance form is term life insurance. It has no cash value buildup, but it has a finite term, like 20 or 30 years, and it will give you, a decent amount of death benefit. But it's not the only answer. There's other ways to insure yourself due to premature death. And when we talk about disability later, I'll also mention some statistics. The chance of dying prematurely versus being disabled for 90 days or longer. So that's, very important. I think, Steve, that you understand when you're young, you're healthy, you're able to get insurance much easier than, when you become our age, because then you have pre-existing conditions.
Yep.
And life insurance companies don't, want to underwrite people that already have issues, medical issues. So buying it now while you're young, while you're healthy, getting the right amount, and then planning for the future down the road if you need to make that a permanent policy.
And the other factor too is people shouldn't look at it, say, all right, I bought X amount of life insurance and I'm never going to look at it again for 10 or 15 years. Because, life insurance, the face amount is fixed. So inflation is eating away at that lump sum. And additionally, your income may have increased substantially. So I know, Howard, you were mentioning the case of somebody you knew that was making a couple $100,000 a year and their income went up to a couple $1 million a year. And they were woefully uninsured in relation to that income level. And the issue, of course, is now you've kind of built up a lifestyle that may have increased costs. You may have two homes, and let's face it, if something happens to you, you don't want your family to necessarily have to sell one of those homes at fire sale prices. So you want to make sure that you've reevaluating your need every few years. And obviously, as your income grows, it won't be as much of a cost. But you're also working against another factor here, as Howard mentioned, that as you're getting older, you do have the possibility of having some health conditions that while you still may get insurance, the insurance company may do something called rate you, which means that you're not going to get the best possible premium. You're going to get a premium at a higher rate because to the insurance company, now you represent a greater risk and your statistical risk of premature death has increased. So they're going to raise the premium amount. So that's an important thing to consider. Like any area of planning, you should not just consider it to be one thing you do and never do again. You should look at it on a continuing basis. And with that said, what types of insurance do you typically recommend for a young family?
Well, as I mentioned, if the affordability is the key component, term life insurance does give you a big bang for the buck. So I would get it from an A+ rated company that has decent permanent life insurance in the event you can want to convert that policy later on. And then, with disability insurance, if you're a physician, you've probably been told to look at this while you're in your residency and fellowship years. And in those years, you can get a starter policy for anywhere between $500 and $7,500 of monthly benefit, with the opportunity to increase that coverage later on with no medical underwriting, meaning that all you have to prove is your income has gone up and you have the right to increase coverage to meet your needs as your earnings go up. So, buying disability insurance is kind of like buying anything when you're younger. It's at a fixed rate. The policies are individual, non-cancelable, and guaranteed renewable, meaning that those premiums are fixed. They can't go up They stay the same until your age of retirement, usually 67 or 70. And then the features of the policy, or what's really important, is that you, as a physician, make sure that the language matches what your specialty is, whatever you're practicing. Because you've gone to school for like 30 years, right, to become a doctor. I'm counting preschool now, but most of our resident fellow doctors are in their 30s. They've been in school their whole life. They've come out sometimes with a lot of student loans. We'll talk about that later also. And so you're very vulnerable in your early years as a physician because you haven't made, the money, the return on your investment yet. It's coming down the road. And the one thing that could take you out of that whole world and financially ruin you would be a permanent long-term disability. And unfortunately, I've seen it happen more than a few times. We don't have a crystal ball, Steve and Greg, right? We can't tell how things are going to play out 10 years, 20 years down the road.
Yeah.
But what we can do is kind of do a analysis of worst case scenario. If something bad did happen, what would I have in place to help me and my family get through it?
Yep. And we typically do that, by the way. And also, we use a statistical process when we run this analysis, because we have to look at for example, the growth in your portfolio of you saving money, but we know that it's not going to grow at a steady rate. It's going to change every year because we know the market's return changes every year. So they call us Monte Carlo analysis, which is kind of a silly name, came from the Manhattan Project in World War II, but it's a statistical analysis. And we'll run through many trials, and we'll also look at those worst case scenarios that Howard mentioned. And so, for example, if you're 35 years old, what happens if you are permanently disabled? And I want to mention something else that, we see more medical professionals that may work for a hospital or a large organization, and they may have a group health plan. Group health plans typically are woefully inadequate in terms of really ensuring your practice, or what you do as a surgeon or a doctor, gynecologist, whatever it may be. And from the aspect that after 2 years, a lot of group plans, the definition of disability changes from your own occupation, or as Howard said, what you really were trained for in medical school, to any occupation. So if you can literally work at McDonald's after 2 years, you're no longer disabled, even though you can no longer work as a physician, any kind of medical professional. So you really want to augment that group plan and really look at it carefully and consider buying coverage on your own in addition to that, right, Howard? You see that frequently, or?
Yeah, I mean, the key here is to get the individual policy first. Because if you have the group coverage already, then that offsets how much individual coverage you can buy. So
that's a great point.
Always try to maximize your individual coverage before you get your group plan through work. And that way you have the best of both worlds. And one other thing about group coverage, Steve, is that it's not portable. So you go to work for some big healthcare system today, and 5 years from now, you're not there anymore. Whatever group long-term disability plan you had is not coming with you. You're going to lose that, whatever 60% of coverage is gone. Now you have that hole to fill, and you have to do it 5 years later when you're older.
That is a great point. That is really a great point, Howard.
So for our viewers, I'm sorry, Steve.
No, go ahead, Greg.
I was just going to say, if I'm hearing you correctly, Howard, it seems like you want to have the proper foundation in place, secure an individual policy while you're young and healthy, right? That's when you can get things for cheap, presumably, and then complement along the way. I also want to go back to just one step here to something you said for our viewers, because I don't want to leave out, I know there's some young medical doctors listening to us. There's also some mid-career and late-stage medical doctors as well. So you talked about figuring out how much do I need, that human life value. Is there I guess if somebody works with you, there's a way to help calculate that, because I'm sure even a 50-year-old surgeon, doctor, etc., if they want to retire at 65, that's still a sizable amount left of economic value before they actually retire.
Yeah. So that's an interesting point about retirement, because there's
Mm-hmm.
actually a disability benefit that we can provide that replaces contributions to your defined contribution
Yep.
and 401k plans. And that's called retirement protection disability insurance. And that's over and above the monthly income you would receive under a normal disability policy. These policies usually cover up to the government maximum. You guys can help me with that number. I think it's 50-something thousand,
Yeah.
right?
Yeah. I don't recall the number offhand because it is inflation adjusted, but it's reasonably high. And actually, you could be as high as actually if you go up to the IRS limit, I think is what, about 60,000 or something. If you include all the way up to the IRS limit.
Yeah, but let's just take an example. You got a 40-year-old,
Mm-hmm.
and he's planning on putting 50,000 away for the next 25 years.
Right.
And lightning strikes, and he's disabled, not, physically strikes, but you know what I'm saying, metaphorically, he can no longer work, or she can no longer work again in their profession. So now you have 25 years where you've lost all those pension contributions, retirement.
Yep.
So this insurance would replace that $50,000, and you guys would help them manage that money every year, but we would pay out $50,000 a year tax-free into an account, usually held in trust, and that money would be used for their future retirement goals now, instead of the actual plan or 401k or whatever plan they have through work.
Yep. And that's important.
That's not something that's been around a long time, but
No. Yep.
I always say, cover all your bases if you can. And, when you buy disability income insurance, you can't get 100% of your earnings.
I was going to say that. Exactly.
Yeah. I mean, the most you're going to get is maybe 60% of your earnings.
Right. Yep.
So you got to fill that hole somewhere, somehow. And this pension retirement disability gives you an opportunity to buy more benefit for that purpose.
Oh, I want to mention something now. If you pay the premiums on disability insurance on your own, now this is an individual policy as opposed to a group plan where it may be paid for you. The group plan, when you receive disability payments, will be considered taxable income, whereas the individual disability policy in which you paid the premium is tax-free income. And a lot of people may not realize that. And I think aren't disability premiums, are these deductible on itemized deduction? I don't recall the answer to that. I think we may have to look that up.
Yeah,
Under medical?
typically, it's non-deductible unless you exceed like 7.5% of your
Right. So
API.
you don't want to do that anyway, come to think of it. Yeah, you don't want to do that. Yeah.
Yeah, we don't recommend it.
No.
Like you just said, you want to pay for it out of pocket with after-tax dollars.
Yep.
So if you have to receive 10,000, 15,000, 20,000 a month, and that's in, tax-free dollars, you do your math on your tax bracket.
Yeah.
You live in New Jersey, New York area,
Be 45%.
45% more in your pocket.
Right. Yes. And how much would you say for somebody starting out would be the average cost of disability policy in relation to their income that they're trying to protect?
We've used this kind of average number of like 2.5%, 2 to 3%. So if you can insure 60% of your gross income tax-free until retirement age for about 2% of your earnings, I think that's pretty good value.
Mm-hmm.
And it's a guaranteed. It's not going to change because I mentioned earlier, those premiums are non-cancelable and guarantee renewable.
Yeah. Effectively, you have a contract with that with that insurance company. As long as you pay the premium, it can't ever go away, that contract.
Yeah, I mean, it's really like a unilateral thing because
Mm-hmm.
the insurance company has to approve you to become a policyholder. But now, once you're approved and you have a policy, the only one that can cancel it is you, the insured.
Unilateral. Yep.
Yeah.
And
Yeah,
so, oh, good, Greg.
sorry.
Sorry, go ahead.
No, I was just going to say, also taking it from the top, for those physicians that are like, well, disability insurance, I don't need it, right? It's the person that is on the weekend fiddling with their roof on a ladder. Those people will get disabled. It's not going to happen to me.
Yeah.
What do you say to those folks when it comes to the
Mhm.
percentage of claims paid of actual injuries versus
Right.
sicknesses and illnesses?
That's a
Yep.
good question, Greg.
Yep.
In reality, what we have seen is 90% of claims are for illness related and not injury. So it's not falling off a ladder.
Yeah.
It's not, driving down the Garden State Parkway and, getting in an accident. Those things do happen,
Mm.
but 90% of the time, it's that illness you never saw coming.
Mm.
Remember, I mentioned the crystal ball earlier. When you're 32 years old and you're healthy, you don't see any of this except with your patients.
Right.
You see that when you're in your office and in the hospital, but you don't think of it ever happening to you. And those are the unforeseen things you're protecting against. And it's typically a long-term illness that can take you out of the picture financially. The other thing I wanted to mention was the student loans.
Mm. Oh, yeah. Mm-hmm.
This has become a very big issue for many graduating residents when they come out of school. Unless they come from, very wealthy families, it's hard to get through medical school without taking loans.
Yep.
And a lot of these policies today now have a student loan rider. So that will pay, again, a benefit separate from your monthly income to help you offset the student loan commitment. Typically, these policies will give you up to $2,500 a month towards it. And the duration is usually around 15 years towards the loan.
That's huge.
Yeah.
I mean, we've
So
seen people with 300,000 in loans.
I like to call it, the trifecta policy. If you protect your income, protect the future from your pension retirement contribution level, and then satisfy your loan requirements in the event you have an early disability, now you've completed the whole cycle of making sure you and your family are okay if something, bad were to happen and take you out of your profession for longer than 90 days.
So we mentioned earlier about life insurance, but Howard, there's some interesting statistics on the odds of becoming disabled versus dying prematurely, right?
Yes. So this again is a number that's been floating for as many years as I've been doing this, which
Yeah.
is a long time, as you know.
Yep.
And it's pretty much like 4 to 1, 4 times more likely to be disabled than dying prematurely. And with medical science getting better and we're living longer,
Mhm.
the number's probably even a bigger spread today. But disability morbidity is still the same. People are still getting sick and still getting disabled. So due to a number of things that we haven't seen before, I'll give you one example.
Mm.
We've seen a big uptick in mental nervous disorder disabilities, emotional issues.
Oh.
I don't have to tell the doctors on this call what happened in 2020, during that pandemic, the young physicians were thrown into, critical care and emergency medicine very quickly. And, some of them came out of that with some PTSD and emotional problems.
I can imagine.
Watching people literally die before their eyes.
Yeah.
So, mental nervous is something that's covered by all policies for the most part. There's a few specialties where they may limit it to 24 months. But basically, that's covered as any other illness, and we have seen a big uptick. In fact, I would say top 5 cause of claim, mental nervous, it's probably number 4.
Interesting. So, oh, good, Greg.
I was just going to say, this is really interesting. Could you share with our viewers what else is on that list? Like, what are some of the illnesses that they should be on the lookout for? What's going to affect them potentially?
Okay, well, probably number 1 is what's been affecting me lately. It's the musculoskeletal system, your back and spine. And I had a phone call from a client about a month ago out of the blue. We haven't spoken in a few years. And he's an oral surgeon, Steve, making very good money, but he's 62 years old. He's had 3 failed back surgeries. He can barely walk.
Oh,
And it's time to file a claim. Now, he's been paying for these policies for 30 years, and he's going to get paid, but he can't stand up and do his job as an oral surgeon.
and they're bending over a lot too.
Yeah.
Yeah.
I mean, that is textbook. That is textbook of what we call an own occupation claim. So he's total and permanent. This guy cannot stand up and do his work for 8 to 10 hours a day. He can't even do it for
It's
1 hour.
hard work, boy, too.
Yeah. So that is a perfect example of musculoskeletal. His back was fine when he bought the policy. He's covered for, that event. So that's like one of their top causes of claims amongst doctors and medical professionals and dentists also. The other one we see obviously is cardiovascular. So, we see people are starting to develop heart disease younger in life due to bad diet, not exercising. They don't go to the gym every day like you, Steve. And, that takes a toll on their heart. So that's one.
Yeah.
And then unfortunately, cancer is the other one. That comes up a lot. So backs, heart and circulatory, cancer, and mental, nervous, and emotional, and unfortunately also alcohol and substance abuse. Those.
Unlike life insurance, where I said the amount is typically fixed, you can have built into a disability policy provisions for inflation and also provisions for growth in your income, because you may insure $200,000 now and you may be making $300,000 a year in 3 years from now. And you kind of built, as I mentioned, built your life around that number. And so your expenses are higher because you've built a different lifestyle. So Howard, there's provisions, right, in disability policies that can take care of that.
Yeah, these policies typically come with features. Some companies call them future increase options or future purchase options, so that you have the right to increase it without having to satisfy any medical underwriting questions. All you have to do is show your income via W-2, 1040 tax return. And we do those all the time. They typically occur on the anniversary of the policy, and they can be either once per year or every couple of years, depending on the company that you're with. And some companies early on have special option dates. As a resident, you're not making a bunch of money yet, right? So your income is fairly fixed and low. And then you get your first job in the real world and you sign an employment contract, your income goes up 5 times. That's a life event where you can exercise your options early, so you don't have to wait another couple years to do it.
Those are important provisions, certainly.
Yeah. And then on the flip side, there's what's called cost of living adjustment riders. And those are tied to either CPI or a fixed rate, like 3% compounded. So if you were 40 years old, in my example, where the gentleman just can't come back to work ever, and he has to collect on that for the next 25 years, you wouldn't want that monthly benefit to be like a straight line. You
No,
want to see it go up gradually, right? So a 3% compound cost of living rider would double your benefit in about, 22 years?
right, right.
So those are very important, that you have the inflation, cost of living, and the future insurability. Because again, we don't know how our health is going to change down the road, but all you need to show is income. There's no medical questions required. So a resident fellow can buy a policy today, lock in a benefit, and then have the opportunity to increase that coverage over the next 20 years with no questions asked.
I wanted to go back to, we're going to go back to this bill in a minute, but I meant to mention something earlier. And if you're going to buy life insurance and you're married, you should definitely consider getting life insurance on your spouse, even if they stay at home, especially if you have small children, because if something happens to your spouse, you're going to want some additional funds to help have a caregiver to help take care of your children. And so you should not leave your spouse out of that consideration for life insurance.
No, not
They
at
have,
all.
look, they have high life value as well. They're taking care of your children, for 10, 10, 12,
You
15.
can make the analogy with hiring a full-time nanny. What does that cost today?
That's right. Yep.
It's not cheap.
No, it's
I
not.
know.
It's
Nope.
not.
I have
Yeah.
a couple grandchildren in New York that have a full-time nanny, and I know it's a big number. But both parents are working full-time, so you have to plan for that, in your budget.
Yep.
But if a non-working spouse is taking care of the family and taking care of the home front, if
Yep.
that person had to be replaced, that could be a six-figure obligation.
It could be, and for many years as well. Now they will get Social Security if you have children under the age of 18,
Right.
but and
Not
I
a
don't
big
think there's
benefit.
any. Yeah, exactly. It's not going to be anywhere near enough.
And I'm glad you mentioned
Yeah.
Social Security. You and I are old enough to actually start collecting it, right?
Before it runs out.
Yeah, before it runs out. But
Greg, you're out of luck. Unfortunately, I'm afraid the way it's going.
We'll see. Luckily, I became a certified financial planner, so
All you can do, Greg, is use 3 different names to get 3 or 4 different checks, like Howard and I do.
yeah, really. But in terms of disability, the component of Social Security is a very stringent system,
Yes.
and about 2/3 or 70% of those who apply for Social Security disability benefits are denied.
Right.
So it's not a sure thing.
No, it's not.
And the average benefit, by the way, is only like $2,000 to $3,000 a month.
That's correct. Yep.
And if you can live on $2,000 to $3,000 a month in New York and New Jersey, I want to meet you.
You're living in a tent in the woods.
Yeah, I want to know where you live.
And foraging for food. Yeah.
Social Security is a very, I don't know what the word is, maybe very conservative and outdated benefit. And people think it's a sure thing, but it's not.
Right.
And if
Yep.
you're in a white collar, white coat profession, and you can do anything in the economy based on your education, training, and experience, you're not going to get approved.
No,
Because
you're
then
not.
You use that flipping burgers at McDonald's analogy.
I know.
You're not far from the truth.
Well, I always remember Social Security, the definition of disability is something that had to threaten your life and result in a reduced lifespan, if I recall.
Yes.
You can correct me on that, Howard.
Actual
if it's not-
language is it has to last over 6 months and could end up, as a end of life event.
That's what I thought too.
Like terminal,
Yeah.
So yeah, people have to be aware. Obviously we're all paying into the system. We hope that those benefits are there for us when we need it. But, Social Security disability is a very difficult benefit to obtain when you are a white collar, white coat professional.
Yes. Now, let's face it, was structured more to help people on the lower end of the economic scale, not
Yeah.
really meant to support people that are in, high level careers like most medical professionals are.
And short-term disability is something that typically your employer provides. That's why most disability policies have a 90-day elimination period,
Yeah.
because you're going to be self-insuring those first 3 months.
Yep.
So, Greg and Steve, you're going to help them plan for those 3 months, make sure they
Right.
have, emergency funds and money set up.
Yep.
They can get through that. These
Well,
policies
you know
are
what
not
they call it,
designed
Howard? We call it having a smart place to get money.
right.
Because you have to plan for the certainty of uncertainty. That's all. That's what we like to say.
There's a reason it's called long-term disability. We're not concerned about the first 3 months.
Right.
That's
right.
not the problem is what happens if it's more than 3 months? What if it's 6 months? What if it's 12 months? What if it's 3
Yep.
years before you can get back to, your profession?
Yep. Yep.
So that's where, long-term, short-term, you want to make sure that the short-term is covered. The state of New Jersey has something called state cash sickness. You have to be a W-2 employee to get it. It doesn't pay a lot of money. I think it's like maybe $400 a week
Really?
for up to 26 weeks. That's better than nothing. But, that usually is integrated with whatever your employer is paying out as well.
Okay. So the employer's payout will be reduced by that number.
Right.
So you get, yeah, interesting. I was not aware of that. Greg, you were going to mention something.
I was just going to say that I think what I'm hearing from Howard and also you, Steve, as you're talking about Social Security is there's a lot of nuances to this, right? To figuring out how much you need and what type of policy, whether it's life insurance or disability, right? If you have children, maybe Social Security will start paying something. You have to look at your resources you have. I think the best way to do it is to look at all of your income sources and run it in a financial plan. Also, from a life insurance perspective, we talked about human life value. For our listeners, you want to run that calculation with a professional. Even better if you could put it in your plan with everything, your tax rates, income, expenses. That'll probably be the best estimation.
Right.
For our viewers, I'm going to offer you a little pro tip here. If you just want to do a basic number crunch, there's a resource online. It's www.lifehappens.org. You can click on human life value, put in your income, how long you're going to get the income for, what's your tax rate, and it'll give you an idea of what that number looks like. Decent starting point, but you want to have something more comprehensive. And then to your point, Howard, talking about disability and these features, it sounds like there's a ton of options you can add. What would you consider the essential riders or add-ons when you have a disability policy? What can you tell our viewers you need to have at least these 2 or 3 to have a solid policy?
Yeah, thanks. I think, to have all your bases covered, no matter what happens to you, you want to have, again, the maximum monthly income that the insurance company will provide based on your earnings. You want to have a 90-day elimination period, and then the benefits out to a normal retirement age of either 67 or 70. So that's elimination period is how much time before the actual benefits kick in. Benefit period is how long they're going to be paid out for. And then as far as the riders and options, we'd already mentioned the cost of living adjustment. That's very important if you're in your 30s and something happens when you're young, because you're going to receive those benefits for 25, 30 years. And then the other feature we mentioned, the future insurability options to increase coverage later on when you see your earnings go up exponentially. There's another feature, it's called residual or partial disability.
Oh, yes, we meant to mention that. Yes, good point, Howard. Yep.
Most of you folks are fee-based for professionals, right? So there's a chance that you could come back to work, and maybe for not as many hours a week as you normally would while you're recovering from some type of illness. And as long as your income is reduced, these policies will help make up the difference in lost income. The better policies will allow it to kick in once your earnings go down by 15% or more. Some are 20%, but that's kind of your range. So until you're earning at least 75, 80% of what you were making before, residual partial disability will keep you whole and allow you to keep receiving a benefit while you're working part-time and getting back to a full-time status at your workplace of work. And, you know, it's not something I would overlook. I think that's important.
No.
Not
Yep.
all disabilities are total. So
That's right. And you don't want it to be an all or nothing type of situation. And you may want to go back to work, but you can't do it, all at once. You may have to, I can only go back to work a day or two a week at the beginning because of whatever disability or illness you have. But you don't have to feel that, gee, if I do that, I'm going to lose all my, my payments. And that's a great thing.
Yeah. And again, language here is very important. Some companies require you show a loss of time or duties, but some companies just say loss of income only. We don't care if you can do all your duties, as long as your income is reduced due to this illness or injury. So residual partial disability, very important, not only for doctors, but anybody that's in a fee-based profession, like
Right.
a financial planner.
Right.
Or
Yeah.
attorney. Yeah.
I want to mention this because Howard brings up some great points, and that's the wording of these contracts with disability. And I'll tell you, this is why I think it makes so much sense to hire a professional like Howard who understands the wording in these contracts. He's seen people make claims. He understands what the pitfalls are in some of the contracts because of the way they're worded, and because he's seen them in action. And it's so critical to have somebody like Howard who really understands these contracts and how the insurance have written them, because they can be, it could be traps in the contracts if you're not aware of them.
Yeah.
And Howard's been doing this for so many years. You've seen so many things, Howard, I'm sure, over the years.
Yeah, I mean, another thing I wanted to mention is that sometimes professionals have access to plans through their associations.
Mm.
It could be, American Medical Society or a state chapter of a specialty organization that they're with. Those are plans you really have to be careful of.
Mm.
They look, very inexpensive going in, but typically
Right.
the rates are actually banded by age. So you pay one rate from like 35 to 40, then another rate from 40 to 45. By the time you're in your 50s, you're paying more money than you would have for the better policy.
Great.
Interesting.
And the policies are not guaranteed renewable. They're conditionally renewable. So if the insurance company cancels a master contract, those certificates that you receive are worthless. And this has happened. It has happened over the years. So be careful with these association plans. They look good on paper. They are cheap, but long-term, they're actually more expensive. The features and benefits aren't as good, and they aren't, guaranteed forever. They can be canceled based on the whims of the insurance company that's behind it.
Howard, that's really an important point, quite honestly, because a lot of times the rates are good initially, and as you said, they can cancel them. That is a really important point. So, look, it's always the same thing. You get what you pay for.
Yeah.
So,
Now, Howard, question for you. So I used to work at MetLife as an insurance agent 17 years ago. I don't know if it holds true today, but with the major disability carriers that are out there, the top 5 or 6, is there ever a situation where you say, you know what, Guardian or Mass Mutual, whoever, they have the best policies, but based on underwriters, and let's say the person you're working with maybe has diabetes and you're trying to get them a disability policy, will you go to certain companies because maybe the claims underwriter has an affinity because maybe their own family member had diabetes? So, what we want to apply here instead of Mass Mutual or Guardian. Can you speak on that a little bit?
Yeah, well, like you said, we're down to a handful of companies that specialize in disability insurance for professionals now. When I started in the business, they told me to go in a room and shut the door and do a spreadsheet analysis of like 30 companies.
Oh.
Okay, I can do that. I can do that exercise in an hour now because there's only 5 or 6.
Crazy.
But, we represent all the carriers. We're independent. We don't hang our hat on any one company.
Hmm.
And you always want to know what company is more appropriate, based on your profile, your medical history. There's all these factors that they use, but, we can always pivot to another carrier that's a better fit. I mean, you mentioned Guardian, Mass Mutual, they're great companies, A+ rated companies, mutual companies, but their underwriting may be more stringent than some other ones. So it's all based on what you qualify for, based on today's medical history and being able to obtain that coverage at a good rate, a standard non-smoker rate. So, like I said earlier, you want to get that policy when you're young and healthy before anything crops up in your medical records that's going to cause a red flag with the underwriters. So we have the ability to go across all carriers and look at your choices. In fact, we do it's actually called an analyzer spreadsheet, and it'll show you every company side by side, price it out per $100 of benefit.
Now, who are I know I gave you 2. I'm just going off of mutual companies I know of. Who would you say are the remaining 4 that you work with, that are competitive?
You've got the Standard out of Portland, Oregon. You've got Emeritus and Principal Financial Group. And then when we have to go, like you said, to substandard medically, we have a company called Assurity Life, able to give coverage to people that wouldn't normally get it.
So you have a few good options then. So.
Now, for our viewers, is there anything else they should know? Even if they're, let's say, 50s, 60s, winding down, reassessing their policies, how would you speak to them? How would you approach them?
I mean, if you're in your 50s, you've kind of crossed over, and whatever disability insurance you have is probably what you can afford, because it does get much more expensive later in life.
Yeah.
But having said that, I see physicians working longer. They're not stopping at age 60 or 65. So you want to take a look at your overall financial picture, as you said earlier, look at how much you would need today, and maybe it would make sense to buy a small supplement to put on top of your existing coverage, especially that one I talked about with the pension. If you're
right.
50 years old and you have 15 years left and something happens, that would be helpful to have that piece added on, because when you bought your policy 25 years ago, that didn't exist.
I was going to say that. Exactly. Yep.
So It's always good to take stock on what you have. We don't usually recommend changing older policies because you paid a lot less and you already satisfied the underwriting,
right,
and the incontestability period.
Right, and the premium's fixed, so
yeah.
So which is important. Go ahead, Greg.
Quick question, just to refresh my memory. Incontestability period, is that 2 years?
2 years.
Okay.
And that's not carrier specific.
That's state
across the board. Yeah. It has, unfortunately, there can be fraud in our industry, misrepresentation.
Right.
It's not easy to prove, but sometimes people are not truthful, and when the claim comes in during those first 2 years, they have a right to not only deny the claim but rescind the policy.
So Howard, how can people contact you? Because if they
either email,
and we work with Howard closely, by the way, but you can reach out to Howard directly. Go ahead, Howard.
And my email address is my first initial H, last name Udoff, UDOFF, at diservices.com.
And I'm also going to put it in the description on the YouTube channel for the video as well, Howard's contact information. So you can, his phone number, his email, and so forth.
Yeah, there's one other comment I was going to make, I forgot.
Sure.
earlier. With the residents, many of these teaching hospitals have discount programs with carriers.
Interesting.
So if you were to buy a policy and get a 10% discount or a 15% discount, that stays with the policy for life. So whatever discount you got as a resident carries over, and it also carries over to the increases later on.
Interesting.
So besides getting it while you're young and healthy and, fixing that rate, those discounts are only available while you're in training.
So essentially they're grandfathered in,
Yes.
and presuming the teaching university, what have you, the hospital, you're kind of maybe stuck with whatever carrier they offer, right?
Or, whatever company has a discount program there. It could be multiple companies, not just one. So we will let you know as soon as you tell us who you're affiliated with, what's available. But if you can get those 10% discounts, 50% discounts locked in at your
Forever.
then that's a good savings.
That is a good savings. That's an important point.
And the last thing I forgot to mention,
Yeah.
there's probably 10 other things I forgot to mention. It's hard to put 46 years into this
Yeah.
1 hour.
To
but
45 minutes. Yep.
There is a gender difference in rates. So females.
Oh, yes. Yes.
Females will pay about 20 to 25% more than males for the same disability policy. And that's across the board with all carriers. It's again due to the fact that morbidity is higher for females than males, always has been. And by the way, most of these policies do cover maternity. So if somebody goes out, if they go out on disability due to maternity, it's covered. But take that out of it, it's still higher. But on the flip side, with life insurance,
I was going to say that it's less. They're lower.
females pay less because they live longer than we do.
Right. Yes.
No, great points. And Howard, we really appreciate you joining us today. You're a wealth of wisdom. Of course, for our viewers, if you want to contact Howard directly, you can do so. And of course, when we upload this to the It's Your Smarter Money YouTube channel, as well as the Wealth Enhancement YouTube channel, we'll have all the contact in there as well. Of course, if you'd like to set up a complimentary consultation with Steve or myself, just to see where you're at, or Howard, once again, we can collaborate. Happy to work as a team and make sure you're making the most informed decisions with your money and your insurance policies. So until next time, thank you for joining us. We'll see you soon.
Thank you, Howard.
Thank you.
Thank you, Howard.
Welcome.